Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about inflation and your retirement account. It seems to be over the last 6 or 7 months, we've heard more and more analysts out there say that there's a possibility that we're going to have to start addressing inflation issues maybe as early as the middle of 2019 or 2020. And usually when you talk about inflation, that usually has most investors feel very uncomfortable. And we're going to talk about really what inflation does, how it affects your particular investments, and then we're going to talk about ways you can invest to try to offset some inflation issues. So the first thing is, what is inflation? In real basic terms, inflation is basically the increase in cost of goods and services over time. So what really happens is you basically lose purchasing power. Your dollar today is not worth what a dollar is maybe in 5 or 10 years from now due to inflation. And as we get along and start talking, Tyler and I, as I said earlier, we will discuss certain investments that you need to look at that could possibly offset some of those inflation risks, okay? Because inflation is a risk that you have to be aware of. So, Tyler, anything else we need to talk about when we talk about inflation in your retirement account, and what is inflation?
Yeah, Dean, so to start off, really right now, inflation is kind of a big buzzword with different economists based on the current economy that we're in now that we're, middle of August 2018. But if we go back to February of 2018, so earlier this year, that's when the inflation talk really started to heat up, because at that time there was a new jobs report, unemployment was at a low. So with unemployment being at a low, that means lots of workers held jobs. Obviously, unemployment's low. People are going back into the workforce. Many people have different jobs. But then with that, that can actually cause a little bit of trouble for employers, because employers who are looking for new employees, there's not as many of them out there, so they have to pay more money to hire, and it becomes much more competitive. So employers are increasing wages for workers, and then, which is good for the consumer, they can get more money that way. But then people have more money to spend in the economy, to go out and buy new things, whether it be a house, a car, or even little things. They can spend more because they're making more. Well, that then drives prices of goods and services up. It's all about demand. It drives it up, and then lo and behold, inflation kicks in. So that whole cycle kind of started earlier this year in February of 2018, and it continued to linger on all the way through up until right now. And the market, it does affect your investments, and we'll get into that a little bit. But as you said, Dean, we'll start kind of with the basics here. And as you said, inflation is simply the increase in cost of goods or services over time. And as inflation rises, every dollar you own buys a smaller percentage of a good or service. So again, like you said earlier, a dollar today might not be as valuable as a dollar was 5, 10, 20, 30 years ago. And to illustrate that, I just have a couple examples here that we're going to start out with that really shows how inflation works over time. So, according to the Census Bureau, the average price of a new home in the U.S. in June of 1998, so going back about 20 years from now, average price of a new home was about $176,000. Now, the same report has the average price of a new home in the U.S. in June of 2018 at almost $369,000. Now, keep in mind, here in the Green Bay, Wisconsin area, that's going to be a little different. It's probably going to be a bit lower than that, but that's the national average. So, you're taking New York, California, the bigger cities and stuff like that, bigger states into consideration there. So that's across the whole entire U.S. But it just goes to show, 20-year difference. A home in 1998, again, that's $176,000, whereas the average price of a new home in 2018 is now $369,000. So again, that illustrates it. Another example here, a gallon of gas in 1994, believe it or not, was $1.06 per gallon. That's the national average. Whereas in July of 2018, the national average per gallon was $2.88. So again, costs of goods and services go up over time. And if we go back, 10 years ago, gas was even more than that average of $2.88 per gallon. But then, so with the cost of goods and services going up over time, the whole goal is to keep up with that. And I also have a figure on that as well. The median household income in 1998 was $38,885. So we'll say just about $39,000. Whereas the median household income in 2017 was almost $59,000. So it did increase by $20,000 over 20 years. But a lot of economists think that the income isn't keeping pace with inflation. So inflation and the prices of goods and services over time are going up by more than people's income and people's wages, and that could have an effect on the economy over time. It's not increasing by so much that it's going to hurt too bad in the short term, but over the long term, that is a concern. But really just wanted to throw some of those figures out that kind of illustrates inflation in the most basic terms, where we can see that it's basically the increase of cost of goods and services over time. Many people can understand that point when you illustrate those examples. So again, what you spend right now, it's obviously going to be different. It's going to be more in the future.
Right. And always remember, too, that our economy and markets work in business cycles. Everything's a cycle. You have peaks and you have troughs. And a lot of investors have seen this before. They show a business cycle. They show at certain points of a business cycle, whether it's a trough, there's certain investments you should look at. There are certain parts of the peak of the business cycle you should look at different investments. If you can envision, we have rounded over the top of the peak and are starting to come down towards what would be a trough. And that's when inflation usually kicks in. Basically what happens is the economy heats up. You hear those buzzwords a lot by analysts and economists. When they start talking about the economy heating up, you typically have the same conversation about inflation, because that usually follows. Now, remember, inflation, you can control it to a certain degree, and that's what the Federal Reserve tries to do by increasing interest rates and pulling some of the easy money off the table that people have used to borrow over the past couple of years, and that tries to keep inflation in check. And that's sort of what we're going through in 2018. We're seeing interest rates increasing consistently, pulling some of that easy money off the table. So when we talk about inflation, how does it impact the stock market? That's what most people want to know. And then after that, what investments can they use specifically to help offset inflation in their portfolios? So really, how does inflation impact the stock market? First of all, inflation causes prices to rise. I mean, it's pure and simple. Rising prices then keep fewer consumers from buying. So what happens? Prices increase, fewer consumers purchase. Basically, companies' revenues and profits decline then, and the economy starts to slow down. That's what happens in basic terms when you're talking about inflation. Now, there's something going on in 2018, too, that everybody's aware of because it's in the news all the time, and that's tariffs. And what's happening with tariffs is you're putting a premium on goods and services, whether they're exports or imports. And unfortunately, we're getting into what is considered a trade war at this particular time. And tariffs are creating a situation where it's going to become more expensive for people to buy. So some analysts and economists out there are saying that there's a possibility that the tariffs are actually triggering potential inflation earlier than it really needs to happen. We don't know that to be for sure, but we are hearing that. Tyler, what else about inflation and how it's impacting the stock market?
Yeah, Dean. So we talked about what inflation is, but But now we need to talk about, okay, how does it impact the stock market? We have a lot of clients in the stock market. We help manage their portfolio, so we need to talk about how it impacts the stock market. People are probably wondering that. And then in addition to that, we're going to get into more specifically, how does it impact your personal investments and what you can do to try and counter it. So like you said, Dean, first off, inflation, it causes prices to rise where people can then purchase fewer goods, companies' profits and revenues decline, and the economy slows down. And kind of like I said earlier, right now we're in a period of low unemployment, which is good for the economy. And however, companies, employers, they do have to be more competitive. They have to pay more to get quality employees. If you're working in a certain industry and your competitor is just down the road from you and they want to pluck you from the competitor, they're going to have to bump up your wage and get you away, because wages is what's going to drive people to go to new jobs. So again, it drives up wages, and then higher wages for the employee means that they're going to be pouring more money into the economy, which is again going to drive up demand for goods and services and then creates inflation. Now, here's how inflation impacts the stock market. Because what happens is once inflation starts to heat up, once demand is going up for for goods and services, then the Federal Reserve, they try and counter inflation. And in order to counter inflation, the Fed raises rates to try and cool the economy, is what it's called. So what happens is inflation's going up, well, they try and raise interest rates. So that's what we've seen, this year. It's not going up by much, but the Fed is slowly starting to raise interest rates. And obviously right now, they're just coming off an all-time low because, if you look in your savings account, if you look in certain money market accounts, CDs, obviously they're not paying a very high interest rate. But part of the thing is the Fed is slowly trying to raise the rates to try and cool the economy, which makes capital more costly for businesses and it dampens consumer spending. Here's how it does that. If you are going out right now and buying a new home or a new car when rates are low, sure, that's fine and dandy, but then once rates start to increase, there's going to be less consumers that are willing to finance a new car or buy a new mortgage. 3%, 3.25% on a mortgage is a heck of a lot better than 5%, 6%, 7%. So again, there's going to be less people that are willing to buy based on interest rates. So the Fed raises interest rates to try and cool inflation, to ultimately try and stop spending and driving up demand. Now, what'll happen then is once consumer spending kind of slows down, in a way that might not be good for stocks, because what happens then is people aren't spending as much, the companies aren't making as much profit and revenue growth, and their stock price is no longer going up as much. So keep in mind, inflation itself isn't necessarily bad for stocks, but what is what the Federal Reserve does to counter inflation, which is raising rates. That has a whole effect on businesses. Ultimately, people are going to be spending less for different products and goods and services, which then will hurt the company's bottom line. It's not good for stocks.
Okay, and as Tyler said, he brought up interest rates. We've been through a long period of time without interest rates increasing, and now we're starting to see interest rates bumping up. It looks like next month we're going to have another increase from the Federal Reserve. And remember, there are investments in your portfolio that are interest rate sensitive, and we're going to talk a little bit about that too. And that is, for instance, bonds. Bonds tend to get stressed when interest rates increase. Preferred stocks also get stressed a bit when interest rates increase. So there are certain investments, if you're in a buy and hold strategy, in other words, your advisor puts you into a portfolio and you just keep the same investments all the time, you might want to look at an actively managed portfolio, because you will have an advisor that's making changes based on not only the stock or investment performance, but also on economic factors, which many people don't really take into consideration, but you really should, especially when we have raising interest rates and inflation on the horizon.
Yeah, good point there, Dean. And again, on the macro level, to counter inflation, the Fed tries to raise rates to cool the economy, which then makes capital more costly for businesses, and it dampens consumer spending, which that's the part that hurts, that can hurt the stock market. Now, on a more personal level, for individuals in their portfolios, because the Federal Reserve oftentimes raises rates to try and slow down spending and counter inflation, here's what happens. Many times investors will sell off in the stock market and instead invest their money in different investments that they perceive as less risky, such as CDs or money market accounts, because they might be paying a higher interest rates, and they might be safe at the same time. So what I mean by that is right now, for example, if the Fed continues to raise rates, you're going to be getting a higher, so again, people who are spending, they're going to have to pay a higher rate to buy, for example, mortgage a car, whatever it might be. But then at the same time, when rates are going up, people who like fixed investments, they're going to be rewarded, because then also, so the rate for buying goes up, but then the savings rates are going to go up as well. So now CD rates might go up, money market, savings accounts might go up. Now they're going up slowly, but what happens again is once interest rates rise, people are going to take money out of the stock market, which is riskier, and instead have that money go into investments that they perceive as less risky, which again could be CDs, money market accounts, fixed annuities, different things like that. So, for example, a year ago, maybe a 3-year fixed annuity was paying 2%. Well, right now it could be paying, 3 to over 3% because interest rates go up. So again, what people are doing is they're taking that money from the stock market and putting that into different fixed investments that are safe, number one, and that number two, they're actually getting paid a decent interest rate, whereas historically in the past, interest rates were at an all-time low. They really weren't making a whole lot in those fixed investments. So again, inflation does impact the stock market. Stocks are typically, they don't do as well, not with inflation, but what the Federal Reserve does to counter inflation, which is raise rates.
Okay. And for those people out there who, whether it's on their own or through a financial advisor, you have a financial plan put in place, make sure you have inflation built into that financial plan. We put together complimentary financial plans for anybody who comes into our office. If you'd like to have one done, just give us a call, stop in our office. We'd be more than happy to put one together for you. Make sure, though, that inflation is built into this, because you could be making decisions to retire on false pretenses on how long your money's going to last if you don't have inflation built in there. So the next thing we're going to talk about is how to position your investments for inflation. But we're going to take a quick break first.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back, and we're going to talk about how to position your investments for inflation. First of all, it just seems to be that we see people make mistakes when they start to get to retirement. They take the extremes into account. What they'll do is, if they have enough money they feel that they can retire on, they typically get too conservative, too safe, and unfortunately inflation erodes that investment or retirement plan. On the flip side, we see people who really want to retire badly. They then make a decision because they might not have enough money, so they're really pushing the envelope here. So they become too risky, trying to catch lightning in a bottle. They basically want to get as much gain as they possibly can, and they're going way beyond their own risk tolerance. So we see those two extremes. However, we're going to look at things too, and we're going to talk about a very simplistic way that we look at a retirement portfolio, and it's a 3-bucket approach. But before we get there, we're going to talk about why getting too conservative can hurt you as much as being too risky going into retirement. Tyler, let's talk about being too conservative and what happens with inflation there.
Yeah, Dean. And before I touch on that real quick, I want to go back to something that you said a couple minutes ago, which is very important, and that's making sure that inflation is built into your financial plan. So just one point I wanted to touch on regarding that was, we have clients all the time that say, I want to target, $70,000 in retirement, $80,000, $90,000, whatever the number is. They say, I want to target, for example, we'll say $80,000, and I want that every year in my retirement. Well, sure, that's fine and dandy. You can target $80,000 in your first year of retirement, but keep in mind, if you still are, withdrawing and receiving $80,000 worth of income 15 years into your retirement, your expenses are going to it might very well likely exceed your income, because again, that's something that people forget all the time. They figure you want $80,000 a year in retirement. Well, they don't factor in inflation, and then if they take the same amount per year through all these years, they're actually losing purchasing power because again, inflation, the cost of goods and services, they increase over time. So again, just wanted to reiterate that very important point you had there, Dean. Always want to make sure inflation is built into your financial plan. Now, with that said, how to position your investments for inflation, what to look for in your portfolio. So again, like you mentioned, one of the major mistakes that pre-retirees and retirees make is actually being too conservative with their investments. And a lot of people don't really understand this. They say all the time, well, I'm getting closer and closer to retirement, or I am retired. I thought I'm supposed to be completely safe. I'm not supposed to take any risk. But no, you might be doing yourself a disservice if that's where you're at, because if you are too conservative with your investments, then what happens is you risk not outpacing inflation. So even though you're earning interest and making money, your returns are then being eaten up by inflation if you have all your retirement funds in completely safe investments, such as short-term CDs, money market accounts, savings accounts, different things like that, which there's plenty of people that do have their investments in different things like that. But right now, in our low interest rate environment, especially when inflation could be heating up, you're technically, sure, you're making money, but yet if the inflation rate is higher, you're actually losing purchase power because your returns are then, like I said, being eaten up by inflation. So a little example regarding that. If your retirement funds are all in short-term fixed investments, like I'd mentioned, short-term CDs, money market accounts, savings accounts, short-term fixed annuities, different things like that, which they're safe, they can't lose money. That might be a big concern of yours, and if that is, then that's a good place to have them. But it might not be a good place to have all of your investments, because right now the inflation rate is currently 2.1%. But if your investments are averaging less than that, then they're being eaten up by inflation technically. So if you're in investments that make 2% or less per year, but yet the inflation rate is right around 2.1%, on your statements you actually see your dollar figure going up, you see them making money, but that money that they make is going to be less than the cost of goods and services are when you go out to buy different things. So keep that in mind. If your retirement funds are too conservative, then you risk not outpacing inflation, which isn't a good thing either. So what can we do to make sure that your investments are positioned correctly for inflation? Well, one way to make sure that they're positioned correctly is by having the 3-bucket approach. And that's a big thing that we use with a lot of our clients. And Dean, I'll let you touch a little bit on the 3-bucket approach, and we'll kind of go back and forth here.
Okay, the first bucket we look at is safety, the second bucket is income, and the third bucket is growth. But understand, not all of these buckets have to have the same amount in them. It depends on your risk tolerance. It depends on your age. It depends on a lot of factors out there. We see some people that have significantly more money in the safety than they do income and growth. We see others that have significantly more in the growth than the income and safety. So if we look at these 3 buckets, like I said, we try to keep it very simple because it's easy to follow. Safety starts out with your fixed income. Fixed income is a term that's usually used when people refer to money that comes in consistently each and every month right into their checking account. That's usually a pension or your Social Security. But in addition to that, savings also shows up in that safety bucket, money market accounts, CDs, and fixed annuities. Okay? Just make sure, though, you still have the ability to make more interest than you probably realize when it comes to safety. For instance, in previous shows we talked about with fixed annuities, there are some out there that have simple interest versus compound. If you're thinking of putting money into a fixed annuity in that safety bucket, please ask your advisor or agent if it's compound interest or simple interest. Always look for the compound interest option if it's available. So that's your safety bucket. We tell people that's the foundation typically for your retirement income. The next one is the income bucket. Tyler, what do we typically have in the income bucket?
Yeah, Dean, so you covered safety, and then in the income bucket, like the name says, we want to try and target investments that are going to produce income in retirement. So A few of those could be annuities, whether they're fixed, index, or variable. There's different types of annuities, but all of them can be used to act as a pension and can be used to be taken as income in retirement, where you get a monthly amount, just like Social Security, every single month till you die. And then in addition to that, also bonds can be used as income, bonds and bond funds, because they pay out interest, which people take as income. Now, right now, bonds aren't very favorable just because interest rates are low. So bonds, high quality bonds aren't paying out a very high interest rate. But at the same time, interest rates are slowly going up. While interest rates go up, bond prices go down. So really, bonds aren't paying out as much in interest as they used to, and their prices are going down, so you could risk losing money with them. But bonds are something else that are used as income. And then one that we really like as well would be dividend-paying stocks, ETFs, or mutual funds. So different dividend stocks where people take those dividends as income in retirement. So again, we have safety, income, and growth. And before we get to the growth bucket, like you said, Dean, you don't have to have the same allocation to each of them. You don't have to have a third to each. For example, someone who's 75 might have 30% of their overall retirement funds in the safety bucket, 50% in the income, and then 20% in the growth. So again, I just wanted to give specific percentages to see how you can kind of break those down. But then lastly, we have the growth bucket.
Okay, one other item though before the growth bucket, Tyler, you were talking about, dividend producing stocks and bonds. Typically, because of the problem we run into with bonds, as Tyler outlined, look at shorter term bonds. It takes some of the risk away that we're seeing in longer term bonds right now. And always remember, conservative doesn't always mean safe, okay? You have to understand that. Conservative doesn't always equal safe. So you need to have that conversation with your advisor. But there's one other thing that we like to look at too when it comes to income, and that's real estate investment trusts. Real estate investment trusts typically pay out the proceeds in the form of a dividend, really, or interest. And the other thing too is actual real estate. Real estate or rentals fits into an income bucket. So you don't have to look at just the stock market when it comes to investments. Okay, as Tyler said, growth. What we're looking at here, we want to get growth in the portfolio too. And this is where you really try to beat inflation. Now we're taking care of safety first. We're looking at income second. And then in your growth bucket, what we really need to focus on here is growth stocks, growth ETFs, and growth mutual funds. And again, we're not really looking at dividend production here. We looked at that in your income bucket. But with growth, we want to try to beat rates of return that are relatively common.
Good. Good points there, Dean. We covered what is inflation, how inflation impacts the stock market, and then how to position your investments for inflation. So all the listeners out there, hope you got a good fill of your inflation for the day.
Yes, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.